let's dive right into this fast-paced explainer. Today, we're unpacking all those overnight macro shifts and locking in the exact technical levels you're going to need for today's trading session. Whether you're actively trading currencies or keeping a close eye on Indian equities, we are going to build out our macro foundation first and then move straight over to the tactical desk. We've got a ton of ground to cover, everything from shifting central bank expectations to these massive relief rallies we're seeing, so let's get right to it.
So what's really wild right now is the sheer juxtaposition between what the markets are hoping for and what's actually happening on the ground. On one hand, you've got markets aggressively pricing in these US-Iran ceasefire hopes, right? And that's brought some temporary calm and actually sent oil prices lower. But then, on the flip side, the on-the-ground reality in the Middle East is literally playing out like a badly written thriller with way too many cliffhangers. We're still seeing reports of US military strikes, deadly Israeli strikes in Lebanon, and just highly elevated tensions across the board. The market is out here celebrating the headlines, but we have to remember, the Strait of Hormuz remains the world's absolute most expensive and fragile geopolitical pressure point.
Zooming out for a second to the global picture, we really need to solidify our macro foundation here. We saw a broad relief rally across global markets last week. US equities hitting fresh record highs because that incredible, almost euphoric AI-driven momentum has officially expanded well beyond just your typical mega-cap tech names. Over in Asia, Japan is really standing out in a positive way. They actually beat expectations on both GDP and exports. But then you look at Europe, and the UK is seriously wrestling with some very weak fiscal dynamics. The absolute crucial point you need to take away from all of this, though, is that this AI euphoria is actively masking some really uncomfortable, sticky realities. We're talking about stubborn inflation, totally uneven global growth, and looming demand destruction risks. And that leads perfectly into what I like to call the great disconnect. Look at the divide on this slide. Wall Street is basically operating with Olympic-level confidence right now. Futures markets are increasingly leaning toward another Fed rate hike by year-end, meaning that higher-for-longer inflation narrative is completely dominating again. Normally, that triggers a massive equity tantrum. But instead, investors are so laser-focused on AI and earnings that they're treating Fed warnings like optional reading. They are essentially pricing in the year 2032. Main Street, however, is a totally different story. Consumer confidence is deeply weak, and inflation expectations are creeping up. Everyday households are genuinely worried, even while the hard economic data remains surprisingly resilient. Now, a massive, and I mean massive catalyst for this temporary market calm is Brent crude slipping back below that crucial $100 mark. Despite some pretty violent intraday swings, traders are cautiously pricing in those US-Iran breakthrough hopes, and that resulting drop in oil, it offered immediate powerful relief to emerging markets, to finance ministries globally, and crucially to global bond yields. All right, pivoting sharply over to the tactical desk, let's break down the major currencies for today's session, starting right off with the US dollar index. The dollar actually lost a bit of ground yesterday during the US holiday, mostly because those hopes for a Middle East resolution really improved risk sentiment in the bond markets. We saw the US 10-year yield trade down at 4.50%, which is practically 20 basis points off its recent highs. So tactically speaking, we're a cautious buy on dips for the dollar today. You're going to want to watch for a solid floor at 99.00, stretching down to about 98.74, while overhead resistance is sitting right at 99.64. It's actually a relatively light day-to-day for the USD, which means our soft point catalyst is entirely about the bond market, specifically keeping an eye on that 10-year yield, and of course, geopolitics taking center stage. Keep your eyes tightly glued to those news headlines today. Shifting gears to the euro, we actually saw a gap up yesterday. Those exact same Middle East peace hopes ended up dragging European bond yields sharply lower across the continent. Notably, the German 10-year yield fell by almost 25 basis points, which is huge. And at the exact same time, European central bankers are out there openly discussing rate hikes for June if they don't get better clarity on inflation. For EURUSD, the chart is maintaining a sell-on-rise structure. But listen, momentum is running super thin right now, so you really need to exercise some caution. Look for sellers to emerge near 1.1656, with your downside target sitting around 1.1612. For your soft point catalyst today, look directly at the ECB's economic stability report that's dropping today, and definitely keep an ear out for any evolving chatter around that potential June rate hike. Okay, let's talk about the UK for a second. Look at this massive number, £24.3 billion. That is the UK's April budget deficit. It's literally the highest April shortfall they've seen since 2020, and it completely destroyed the $20.9 billion estimate.
This awful fiscal data, paired up with a softening labor market, is putting the Bank of England in a very tight, very uncomfortable position. And because of that horrendous fiscal data and the fact that UK retail sales just dropped 1.3%, which is nearly double what was forecasted, the pound remains incredibly volatile. Tactically, GBPUSD is firmly in a no-trade zone right now. We are waiting to see a clear, definitive breakout above 1.3564 or a total breakdown below 1.3393 before committing any capital. Honestly, sometimes the best trade is simply sitting on your hands and waiting for clarity. Heading over to Asia, let's take a look at the Japanese yen. What's super fascinating here is that the yen has been remarkably, almost stubbornly flat for the last 5 days. It is holding its ground even in the face of the broader US dollar retreating and even as Japanese 10-year bond yields fell 10 basis points from their recent highs. So tactically, USDJPY is a buy on dips. We've got resistance mapped out overhead at 159.77, with support bracing the downside at 158.35. Our soft point catalyst is pretty huge today. We are waiting on today's Bank of Japan core CPI print. Last week, Japanese data was phenomenal with that stellar Q1 GDP beat and strong exports. So we're watching closely to see if today's CPI gives the Bank of Japan the exact window they might need to actually hike rates.
All right, bringing it back home to domestic markets. The Nifty 50 just surged to its strongest close since early May, hitting exactly 24,031.70. This was a classic textbook relief rally. As those crude oil prices fell on geopolitical hopes, it briefly restored a lot of investors' faith in risk assets, pushing Indian equities right up to a 2-week high.
Let's break down this impressive relief rally a bit more. The Sensex gained 1.42% to close at 76,488.96. And what we absolutely love to see here is broader participation. Small caps joined the party, up 1.4%, and mid caps gained 0.9%. On top of that, India's benchmark 10-year bond yield absolutely plummeted, posting its sharpest drop in 3 weeks. Traders essentially rushed in, hoping that cheaper oil is finally going to spare the RBI a major inflation headache. And as a direct result, the rupee actually strengthened for a third straight session.
Speaking of the rupee, let's check out the USD-INR tactical setup. On a daily time frame, the structure clearly dictates a sell-on-rise setup. You've got resistances sitting at 95.43 and 95.61, with supports below at 94.92 and 94.77. The soft point catalysts driving this are those ongoing geopolitical peace hopes and dollar-rupee forward premiums dipping, with the 1-year implied yield coming in lower at 3.25%. But the absolute key takeaway for you here? We need a weekly close breaking below that 94.77 support to officially confirm this downward structure. You've got to watch that level closely.
Looking ahead to the rest of the week, the calendar is just absolutely stacked. All eyes are going to be glued to the US PCE inflation report. Remember, that's the Fed's preferred gauge. This single print is going to dictate if pricing pressures are actually cooling off or if that higher for longer reality is locked in. Wrap that up with US GDP, durable goods, and Japanese retail data coming out, and it's crystal clear. Markets are remaining completely hostage to central banks fighting for their credibility, all while geopolitics constantly throws a wrench into the works. So I'm going to leave you with this final thought, as geopolitics tries very, very hard to ruin everyone's spreadsheets this week. As you navigate these charts and trade these levels today, ask yourself, are we looking at true, genuine market stabilization here? Or are we just enjoying a fleeting pause, a temporary ceasefire with macro reality? Keep your stops tight, always respect your technical levels, and stay focused out there.